At the end of the day, business valuation really comes down to what's somebody willing to pay today for the future cash flows of a business. And so we'll kind of talk a little bit about business valuation. First, we'll talk about the purpose and the standard of value. So the purpose of a business valuation, there's numerous purposes. Most likely, it's going to be you're going to need a business valuation when you're going to sell your business or somebody's coming to you and wants to offer to buy your business. There could be tax reasons such as estate or gift. ESOP purposes, you're definitely going to need a business valuation when you form an ESOP, and most likely will need a business valuation annually in order to allow ESOP participants to transact. Also, I do a lot of business valuation in the area of divorce when a couple is splitting up and one of the assets inside the marital estate is a closely held business. At the end of the day, the reason why these business valuations are needed is because unlike a publicly traded company, you can't open the Wall Street Journal and determine what the value of your business is. So business owners will hire valuation analysts such as myself, and through a combination of art and science, we'll come up with the value of the business. My business card actually says Michelangelo of business valuation. So. Not on here though, on this schedule is the standard of value, and that's very important to understand. Mainly we're dealing with typically two types of standard of value. One is fair market value. In fair market value, the technical definition is the price that the property would change hands between a hypothetical willing buyer, a hypothetical willing seller, both parties knowing all of the reasonable facts and circumstances of the business. The other standard of value that we deal with is investment value or strategic value. And the difference there is that's the value to a particular investor. To kind of give you an example, I want to talk about a case that we're working on right now. There's a business that is a client of our firm that wants to sell their business. We went through and said, well, what is the current value of the business? And the business owner had an idea but wasn't sure. So we went through and did a fair market value of the business. And we told them this is fair market value, not investment value. But we came up with a price of $40 million for his business. A couple months later, he's gone through the process, due diligence, and actually has 3 different bidders bidding on his business right now. And the prices are coming in the range of $52 to $55 million. So was our valuation of $40 million wrong? No. It's because the standard of value was fair market value, and those $52 to $55 million values are investment or strategic value. These particular buyers are looking at this business, seeing how they can take that product, incorporate it into their business, perhaps reduce some of the overhead, such as the administration, and so that value actually is higher. So one of the things we'll talk about later on is how to exit your business, and if you can find a strategic value, the result of that will actually be a higher value for you. All right, so there are 3 different types of methods that we use when we're valuing a business. There's the income method, the market approach, and the asset approach. And underneath those approaches, there's different types of methods. For example, the income approach, we can look at the historical operations of the company and use what's called a capitalized cash flow method. Or we can look at the future projections of the company and use a discounted cash flow method. At the end of the day, I'm not going to get into the semantics, but those values should be the same because if you're looking at the historical, you're basically projecting what the company is going to do in the future. The market approach, think about it as if you're doing a real estate appraisal. You have 2 homes in the same subdivision. You know, one might have a 2.5 baths, one might have 3 bedrooms, 1.5 baths. And you try to compare what's actually been sold and try to apply that to your particular piece of real estate, or in this instance, your particular business. The problem with that is no 2 businesses are alike. When you start throwing in the management team and the product mix and the competition in the industry, it's very hard to find comparable companies out there from a transaction perspective. If your company's large enough, you might be able to use what's called the guideline public company method, which is when you are able to actually use data from the public markets and apply those multiples to your particular business. Then we also have the asset approach, which is the third approach. And that's basically taking the fair market value of your balance sheet, the assets minus the liabilities. And they've thrown on here a fourth approach, which is the country club approach, talking about, hey, my buddy was able to sell his business for 3 times EBITDA, and we'll talk about EBITDA in a second here. My business should at least sell for that. That's kind of, the old rule of thumb approach. So just because, again, one business sold for something doesn't necessarily mean that you'll be able to sell your business for that same price or more. And remember, what we're talking about here is value is what somebody is willing to pay today for the future cash flows of your company. And so as those cash flows are being analyzed, you've got to consider the risk as to whether or not you'll be able to achieve those future cash flows. And the more risk there is in the ability to achieve those cash flows, the lower your value. And so one of the breakout sessions we're going to talk about later on is how to de-risk your company. And so, again, trying to look at, how to make this kind of nothing's guaranteed in business or in life, but trying to make sure that these cash flows are going to be guaranteed. All right, so I used the term EBITDA, and we'll talk a little bit about what that means right now. EBITDA is simply earnings before interest, taxes, depreciation, and amortization. And I know a lot of the breakout sessions later on will use this term as well, so we might as well just define it up front. One of the things that you often hear is, a multiple of EBITDA is a way to value the company. Typically, we see when we're dealing with fair market value in the 3 to 5 times EBITDA range. If your company is performing very well, you might be at the higher end of that range. If there's a lot of risk in your company, you might be at that lower end of the range, or maybe even outside of that range, either on the positive or the negative. For example, the example that I was dealing with, the $40 million company, it was slightly, just a little bit over a 5 times EBITDA. From a strategic investment value, though, it ended up being about a 6.5 to a 7 times EBITDA. All right, so here's an example. Business owners are always asking, what should I focus on in order to increase value? And so we've got an example here, a company, let's say they do about $3.5 million in revenue, have a $500,000 of EBITDA, which is about a 15% margin, and currently it's valued at a 4 times multiple. So some business owners will say, well, if I can just increase revenue, that will increase the value of my business. But if you think about it, revenue, $1 of revenue might only generate 15% income, and at a 4 times multiple, that's only increasing the value, 60 cents for every dollar. If you focus on increasing the bottom line, that net income, perhaps by reducing costs, maybe for every $1 cost at a 4 times multiple, that's a $4 increase in value. But if you take a bigger picture and try to focus on de-risking the company and increasing that multiple, you'll see that the value can increase exponentially. For example, if you're able to shift your company from a 4 times multiple to a 5 times multiple, that $500,000 EBITDA company now is worth, an extra $500,000. At the end of the day, really what you're going to do is you're going to try to focus on all of these. And the fact that if you focus on trying to increase the value, you're probably going to increase risk and reduce costs at the same time. And that's going to be, we are going to have a breakout session later on that's going to solely focus on value drivers, value threats, and we're going to go into detail on how you can set your company up in an ability to de-risk your company that will actually result in an increase in the multiple.